I think the structural issues that Apple faces are still issues and questions in my mind. The stock is up, I think, ostensibly because people were bracing for potentially something worse. On net, I think estimates came down about 5%. Stock's up about 5%, so it's 10% more expensive today than it was yesterday. Maybe people were bracing for worse, and I think that's what the stock's saying. But on a fundamental basis, I'm not sure we learned all that much, nor were our longer-term concerns, mitigated.
I mean, to be clear, you're surprised by the move in the stock, and you don't necessarily think it's justified, do you?
No, I'm surprised because I think people were kind of on the fence saying, well, maybe they can reaffirm sort of current estimates, or maybe they'll guide down a bit. And they did guide down on both revenue and gross margins. So at least through my eyes, I thought that was a little bit lower than, sort of the broader buy side was expecting. But, the market is suggesting maybe not. Maybe folks were bracing for that or something worse.
So what do you do, though, with the stock then? It's not that far away now from your target. Mm-hmm. So what do you do?
I think it's a do nothing for now, because in the near term, the valuation is not compelling. We look at Apple's valuation over the last 5 years on cash flow and earnings multiples, and it's a little bit above that average. So it's not jump up and down inexpensive. And I think the next iPhone cycle is unlikely to really drive a resurgence in units. We think more likely a couple years from now with the introduction of 5G, could we see something that really gets people to upgrade more quickly. So in the absence of having valuation being compelling, my principal longer-term concern remains intact, which is the average upgrade rate for an iPhone today is still under 3 years. That could go from, call it, 2.75 to 3.5 years. And if that were the case, you could see iPhone annual volumes go down 25% from here. And that ultimately is the key question, particularly since it's unclear that Apple can continue to raise price going forward.
I misspoke as well. I mean, your target's 160. The stock's at 162. It's obviously a couple of bucks above it. Here's a question for you. I want to know how you look at Apple today. Is Apple a great product company with a product company with great services, or is Apple a services company now with great products?
It's a great product company. I think it always has been a great product company, and its products today are still leaders, particularly in the premium price points of their respective end markets. Now, to Apple's credit, it has built a services business on the back of those great products, but it's the products that drive the installed base, and it's the installed base in turn that affords Apple an ability to sell into it with services. And I think just from a mind share perspective, people don't run out and talk about iCloud or Apple Care or Apple Music as the reasons why they love Apple. They talk about the iPhone or they talk about their watches. So I think even from just a consumer mind share perspective, Apple is first and foremost a product company. And again, kudos to them for using that installed base to drive a business on top of it.
Do you think the company is innovating enough to continue to grow its services business to the level it would need to be to make up for the fact that the iPhone business, the bread and butter, is slowing?
That's the challenge, and Apple faces, the fact that it's an enormous company. So, very, very simplistically, the iPhone plus iPad plus Macs are about 80% of revenue, so call it about $200 billion, and services is about $40 billion, so it's 20% of revenues, roughly speaking. And so that math is very difficult to work. If the hardware business is 80% could go down over time, then you really need outsized growth in the 15% from services and maybe another 5% from wearables, which are watches and AirPods at this point. You need outsized growth from that remaining 20% to have total growth for the company. And that's the challenge. The services business in and of itself is a huge business, $40+ billion.
Sure.
The challenge is the rest of the company is a $200 billion business with revenues perhaps more likely to go down than go up.
Tony,
Sorry.
hang on real quick. Margaret wanted to ask a question. One of our panelists, Margaret Reed, wants to ask you a question, Tony. Then we'll hear from Weiss. Go ahead,
Hi,
Margaret.
Tony.
Hey,
Just
Margaret.
on the topic of video and content, obviously Apple has been late to the game relative to competitors of Amazon, Netflix, YouTube. Tim Cook obviously mentioned the intent to talk about the cable bundle and the unwinding of it. What do you think their intentions are in terms of getting into the content, and at what cost? And will it actually improve them from being more relevant to consumers and what they want to do in terms of the services business?
Sure. So, yeah, they did allude to the fact that, they have a strong interest in content, that they believe that the cable bundle will become increasingly unbundled. I'd make a couple observations. This is certainly not the first time that Apple has suggested this. In fact, over the last 3 or 4 years, they've made many references to the fact that television was ultimately getting unbundled, and Apple saw great opportunity there. So the commentary was not unique. Now, there's increased evidence in terms of Apple's investments, in terms of hiring people, spending on original content, news stories in the marketplace that suggest that Apple could bring to market some kind of content offering, with or without partners, bundled with an existing service or standalone. Those are key questions. Again, I think in the context of overall Apple, sure, this could help, but only in a very small way. I mean, you think about Netflix as kind of a $15 billion company. Apple might be lucky to drive an incremental $1 billion in content revenue in 1 year, again, on a base of $250 billion, especially since that content would likely be at lower margins. It's not a thesis changer.
And the upfront costs on content themselves, it takes a lot of time to actually get that return of that capital.
Correct. So the margins initially would be dilutive to the company overall. So the margin or profit impact would be even less.
Tony, just a question on margins, actually, margin dollars. So the company's opaque in terms of disclosing that. They don't tell you that. But even if services grow, the margins on services, given the margin dollars on services, have to grow exponentially to offset the margin dollars that you get from the iPhones, which are, I've read estimates anywhere from $300 to $600 a phone on the top price phone. So that's not going to be enough to offset that and drive the bottom line's earning growth. Would you agree with that?
Yeah, I mean, look, it's all a degree of magnitude, right? I think the simple way to think of it is maybe 80% of the profits of Apple are iPhone and other hardware related, and 20 to 25 might be services plus growth parts of the hardware business. And so accordingly, you really need something that is, growing 3 times. So if the 80% is declining at 5%, you need the remaining 20 or 25% to grow at 15% or more, just for that profit stream to be relatively flat. So that is a challenge. Now, encouragingly, services gross margins are higher than hardware margins. And so, that is helpful, but you're still left with this conundrum that it's a relatively small part of the business.